Okay, welcome to today's class. Today we are starting a revision, or so to say, a special emphasis on consolidated financial statement of financial position. Consolidated statement of financial position. Now, we are going to look at the theoretical background and the format. Now, what is a group? We are going to be looking at the division of a group. A group is a parent and a subsidiary. A group is a parent and a group is a parent and subsidiaries. A parent company is an entity that has control over another entity. A subsidiary is an entity that is controlled by another. For example, the wife is controlled by the husband, so the wife is the subsidiary while the husband is the parent. Then what is control? Control is defined by IFRS as an investor controls an investee when A, it is exposed or has rights to variable returns from its investments with the investee, and B, it has the ability to affect those returns through its powers over the investee. So where you have expectation to receive return from a company and you can affect whatsoever you receive as a return, you are said to have a control over that company. Situation where control exists, I explained this, you can read that up. Now, purpose and nature of consolidated financial statement. Now, the nature of consolidated financial statement is in that the assets and liabilities of the parents and the subsidiaries are combined together. You already might have heard about this. What do? You add that of the parent company and that of the subsidiary. That is what we call combination, and that is just group. But there are little intricacies in this aspect, and that is what we are going to be looking at. So we have profit or loss and other comprehensive income are combined in a consolidated profit or loss and other comprehensive income. So now, requirements to prepare consolidated financial statement. IFRS stated that a parent and a subsidiary shall prepare a financial statement as if it is of a single entity. You understand? But there are exemptions. Why should a company be exempted? This came out in last 3 diets. 1. The parent company is a wholly owned subsidiary. So if your parent company is a subsidiary of another company, IFRS is saying do not consolidate. You understand? For example, company A has a subsidiary, company B. Now, company A is a parent of company B, but company A is owned by company Z. So company A cannot prepare consolidated financial statement. That is what IFRS is saying. B, the parent's debt or equity are not traded on the stock exchange. So if the parent company's shares or debentures are not traded on any stock exchange in the world, you don't need to prepare consolidated financial statements. Another one is the parent does not file financial statements with the Security Commission. So these are the exemptions, note them. Now, common accounting issues. The first accounting issue is 1. You should, they said the IFRS requires that the parents and subsidiaries should have common reporting dates for the presentation of CFS. Where it is impracticable, adjustment need to be made for all transactions. The difference in date should not be more than 3 months. So now, one is the parent company and the subsidiary must have the same accounting date. 2, they must have uniform accounting policies. So these are the accounting issues. That is what IFRS provided. Now, consolidated statement of financial position, the basic approach. Now, stage 1, for examination purpose, stage 1 is saying this you will make adjustments to some wrong entries that were entered in the book of the parent company and in the book of the subsidiary. After you've made this adjustment, stage 2, you now consolidate. How do you consolidate? You add them together. How do you add together? You say parent company. You say parent company you say P plus S. You understand? Is equal to your consolidated financial statement. So this is how you consolidate your consolidated statement of financial position. That is how you consolidate. So you add the assets and liabilities of P and that of S. We'll see this when we start. This is called accounting group equation. You understand? So the group is equal to parent plus subsidiary. So the assets of the parent plus the assets of the subsidiary will give you group. The liabilities of the parent plus the liability of the subsidiary will give you group. But there are things you must note. The cost of investment of the parent company does not come in. Whatsoever the parent company spent in buying the subsidiary, you don't consolidate it. It doesn't come into consolidated financial position. Now, another one is the ordinary share capital. The ordinary share capital of the and share premium of the subsidiary does not come into the consolidated financial statement of financial position of. You understand? So these are the two things that don't come in. You will see it. Let's now look at the necessary workings. You will do are goodwill, consolidated retained earnings, and NCI, non-controlling interest. When we take a question, you see how these are done. Now we'll move to net asset summary. This is a format of net asset summary. You must know this and make it your friend. 1. Date of consolidation will now be ordinary share capital of the subsidiary. You bring it in at the date of acquisition and date of consolidation. It will be the same. Share premium of the subsidiary, you bring it in both at the date of acquisition and at the date of consolidation will be the same. Retained earnings will be different for date of consolidation and date of acquisition. I will explain this better when we take a question. Now, let's now look at two most important things that I want us to know. And those two most important things are pre-acquisition and post-acquisition profit. Now, pre-acquisition profit is that profit that the subsidiary made, that the wife had before the husband came to marry her, before the parent company came to acquire it. That is pre-acquisition profit. While post-acquisition profit is the profit that the wife made after the husband married her. That is post-acquisition profit. So this will help you to understand when we say pre-acquisition retained earnings and post-acquisition retained earnings. So you just use wife and husband. Pre-acquisition retained earnings is the profit or retained earnings that the wife had before the husband came to marry her. While post-acquisition retained earning is the profit that the wife made after the husband married her. I hope that makes sense to you. So now we'll be looking at this question, this format, this question to help us. Now they say P acquired 100% of the equity share of S on incorporation of S. The date of this transaction was 31st December 20x1. This is known as date of acquisition actually. The cost of investment was 120,000. So when P was buying S, P paid 120,000. That is bride price. So cost of acquisition can be likened to bride price. Good. Now, S had net assets. And what is net assets? Total assets minus total liability when it was first set up of 120,000. The statement of financial position of P and S as at 31st December 20x1 are now as follows. PS, non-current assets, property, plant and equipment. We have this value, 640,000. Investment in S, 120,000. Current assets, 140,000. Equity, share capital, share premium. You understand? And retain earning. You can see they give us one of the holding company and the one of the subsidiary. So P is a parent company, while S is the subsidiary. Now, they now say you are required to consolidate this. Now, what did I tell you? I said in consolidation, you see P plus H and plus S will give you our consolidated financial position. But while doing that, there are only two things that will not come in. The cost of investment of P and the ordinary share of S will not come in. So let's try that. So when you want to prepare your statement of consolidated statement of financial position, you will now say property, plant and equipment. You bring in that of P plus that of H and S. It will give you this value, which is now group. Remember, I called it group equation. So PPE of P is 640. S is 125. Now, you come again, current assets. You bring in P own is 140 plus this. It will give you this. You add up. Did you see we didn't bring in the cost of investment of P? The cost of investment in Nest. This is cost of investment 120. It didn't come in the consolidated financial position. We now move to equity section. You bring in only the ordinary share of the parent company. What is the ordinary share of parent company? 200,000. That is what you bring in only. Now, share premium. You bring in that of parent company, which is 250,000 only. Look at it, 250,000. You understand? Retain earnings. You now bring in the retain earning of both companies, but the company was acquired at inception, so it does not have retained earnings. So you take only that of the parent company. So you bring it in 350. You add together, you have 800,000. So you now bring in the current liabilities of the two companies, which is 100,000 plus 25,000. Which will give 125. If you add up, it will give you 925,000. You can see that it balances following that group equation, and also not bringing in cost of investment and ordinary share and share premium of the subsidiary. We will stop here for today. I hope you understand this concept very well. We'll take another question in our next class. Thank you.